capital and the retained income. Prepare the following notes to the balance sheet. So let's go to the information. The following totals or balances, among others, appeared in the books on 28 February 2017. So we are not given the ordinary share capital and the retained income. There is a question mark. And then the gross profit for the year ended was calculated at 3,150,000. Okay, we want the one that is affecting the ordinary share capital and the retained income. So let's go to information G. The company is registered with an authorized share capital of 1,200,000 ordinary shares. So the authorized shares, they are 1,200,000. So they are 1,200,000. So here they are. Okay. And then they are saying 85% of the authorized shares were issued on 1 March 2016. 85% of the authorized shares were issued on 1 March 2016. Okay, so let's do some calculations. So the authorized shares, the 1,200,000 times 85% is equal to, so 1,200,000 times 85% is equal to 1,020,000. So the shares issued at the beginning of the year, they are 1,020,000 because our year starts on 1 March 2016. We are given that information. The year ends on 28 February 2017, meaning that it starts on 1 March 2016. Okay, let's continue. On 31 March 2016, the directors issued all the unissued shares. EFT payments totaling 756,000. So we have the shares issued on 31 March 2016. So the amount is 756,000. It's here. 756,000. On 31 March 2016, directors issued all the unissued shares. So because 85% shares were issued, meaning that only 15% shares are left. So now, we're going to say 1 million. Okay. So we issued 1,020,000 shares, and then the total shares were 1,200,000. Now we are told that all the unissued shares were issued. So let's calculate the unissued shares. Is equal to equal to 180,000. So at the beginning of the year, we issued 1,020,000 shares, and then we were left with only 180 shares, but now we are told that we have issued those 180 shares, the remaining ones. So we issued 180 million shares. We have issued 180 shares, okay? And then on 27 February 2017, the company repurchased, so we have repurchased 250 shares, okay? 250 shares. So this is the buyback, or what we call shares repurchased. Buyback. So the price that we use is not the one that is given, but we have to use the average price. We are told that they were bought back at 415 cents, but we don't use this price. We must use the average price. So to get the average price, we must say, let's make the calculation. So to get the average price, we must take the total of this. So 3,084,000 plus 756,000 over 1,020,000 plus 180,000. So when you divide them, they give you a average share price of Rand 20. So this is the amount that you're going to record it on your ordinary share capital. So then the difference between the average price and the price that they were bought back with is the amount that is going to the retained income. Let me say this again. The difference between the average price and the price at which the shares were bought back is going to the retained income. So 250 times Rand 20 is equal to 800,000. So if you add these two and then subtract 800,000, you get 3,040,000. And then here we are going to add these two and then you subtract the buyback. Then you get 950 shares. Okay. Now we are going to the retained income. So let's just go back. Let's just go straight to the buyback. So the shares that we bought back, they were 250. And now at what price? So I said the difference is the one that is going to the retained income. So they were bought back at a price of 415 cents. 415 cents minus Rand 20 is equal to 0.95. Let me check. It's 415 minus Rand 20 is equal to 0.95. This is your buyback. So 250 times 0.95 is equal to 237,500. So we subtract the buyback of shares. Okay. Then here we have the net profit after tax. Okay. Let's continue. Interim dividends were paid on 6 September 2016. So let's go and check the interim. Let's check. So we have the interim dividends here. Ordinary shares, then we are told that these are the interim. They were 420. So let's record the interim. Interim dividends 420,000. And then we have the final dividends. So what are they saying about the final dividends? A final dividend of 25 cents per share was declared on 28 February 2017. All shareholders, including the repurchased, were entitled to the final dividends. This must be brought into account. This must be brought into account. Okay. They said including the shares repurchased. So if they are saying including the shares repurchased, meaning that we are going to take the shares before there was a buyback. We are going to take the amount of the shares before there was a buyback, meaning that it is 1,020,000 plus 180,000, which is 1,200,000. So 1,200,000 times 0.5 cent, because it's 25 cent. So times 0.25 cent is equal to 1,200,000 times 0.25 cent is equal to 300,000. These are the final dividends. They are worth 300. So it's 1,200,000 times 0.25 cent is equal to 300,000. So if you add the two, they give you 720,000. Now we are left with the net profit after tax. But here in information F, we are given some information. Income tax at 32% of the net profit amounted to 396. So the income tax is 396,800. So now we want to calculate the net profit after tax. So we are told that the income tax is 32%. So below you need to put what you have. So what we have is the money for the income tax. So the income tax is 32%. Then because we are looking for the net profit after tax, so to get the net profit after tax, you see a net profit, which is 100% minus 32 is equal to 68. So meaning that 68 is the net profit after tax. So what we're looking for is the net profit after tax. So above you put what you are looking for, which is the net profit after tax. So times 68 over 32 is equal to 843,200. Then now let's add them. So if you add them, 674,500 plus 843,200 minus 237,500 minus 720, you are going to get 560,200. Thank you.